I'm glad you're now here. Thank you, sir. All right, let me call this meeting to order, please. Mark, what's that?
Sorry, I'm late.
That's okay. You own the purse strings, so you can dictate the time. Anyway, Mark, any public speakers?
Yes, there are. Thank you. There are 4 speakers, 1 in person, 3 remote. The first in-person speaker is Jason Anthony.
Hey Neil, nice to see you again. Jason Anthony from the ALU. This time I'm gonna speak about budget. Um, I've been writing the system more and more and more. Here's the thing that I want to address. I've been seeing more people not paying their fare on the subway. I've been seeing people not paying their fare on the bus. Neil, especially. Get this. This past weekend, I was on the B41 bus from downtown Brooklyn to Kings Plaza, and there were people, listen to this, boarding through the rear door. If we were in states like, for instance, Florida, the bus driver will literally stop the bus, let the passenger know if they don't have the fare, they will not board the bus, and they will call the police. We should do the same here. Have fare enforcement. Because guess what, Neil? Our agency is in deficit. This is why we need congestion pricing. Because get this, I'm the only one of Amazon Labor Union that comes to these meetings. Because all the rest, they only take care of taking Ubers, Lyfts, but I'm the only one that contributes to taking mass transit and contribute to pay my fare, pay the tolls like every single New Yorker. But let's get the message to New Jersey to do the same. So I'll see you guys on Wednesday.
Thank you. The first remote speaker is Charlton D'Souza.
Good afternoon, everyone. My name is Charlton D'Souza, President of Passengers United, and my comments go to Mark Young. Mark, we need a unified city ticket between Metro North and the Long Island Railroad. So if you're traveling from Fordham in the Bronx and you want to go to, let's say, Rosedale in Queens, you can ride both the Long Island Railroad or Metro North combined, and it would just be $5. That would be a great thing. And going to the Atlantic Terminal in Brooklyn, I was at the finance meeting, y'all were discussing it and going through it. I feel that if the trains are going to run every 20 minutes and we have to walk all the way to platform F, I think that the Long Island Railroad should just charge $2.75. Put turnstiles there and make that like a subway shuttle. Like from, you could have railroad trains operating, but let's do a marketing campaign. Turn it into the Queens Brooklyn Express shuttle, and people can use their Metro cards. Now, Long Island Railroad riders, they would just ride for free. It would be in Zone 3. You would make Atlantic Terminal. And like this, it's a win-win for everyone. So, they're getting more trains, but because they have to walk and they have a 2 or 3 seat ride, they're getting that discount. So everyone's happy, and that's going to make the system better. So I think that's what needs to be done with Atlantic Terminal in Brooklyn. Otherwise, I do feel that we do need a weekly pass that is either $45 from Zone 3 stations in Queens, where we could just go to Penn Station or Grand Central, like a $45 weekly ticket. That would be a game changer. Something like the Atlantic Ticket Pass weekly, but it should be called Freedom Ticket. So again, thank you, everyone, and I'll see you next at the board meeting on Wednesday.
Thank you. The next speaker is Andy Pollack.
Hi, Neil. I do apologize for joining on the phone today. I am coming back home from work at Austin Hall, but today I do want to discuss about congestion pricing since my schedule was a little bit crazy back in August. So let's talk about how police, first responders, EMS, firefighters are going to get double crossed if they get charged the congestion pricing fee. You know, that's a little bit ridiculous. Japan does that, and I don't know how they tolerate that. So that needs to be in the exemption for our brave first responders who obviously have to deal with a lot of the Manhattan gridlock. The second thing and the last point I want to make, I have family in Manhattan, and I'm very worried that they're going to have to pay the congestion pricing fee below 60th Street, because I have a lot of family who, of course, go into Long Island and, of course, Staten Island, and I'm very worried that it's going to cost them to, of course, go each direction and pay this congestion pricing fee. You know, I have cousins in Staten Island who don't want to take the ferry. They insist on driving. My other cousins who live on the Upper East Side, they have family in Long Island, and they don't want to drive. So Manhattan residents need an exemption because, you know, you can't be double crossing them. You know, that's the bottom line. So that's pretty much it, Neil. Thank you for letting me speak this afternoon. And I'm not going to be speaking at the board on Wednesday. I have to speak to New Jersey Transit. So that's pretty much it. Take care, and I expect to speak to you all again in October.
Thank you. The final remote speaker is Andy Quito.
Hello, guys. Good afternoon. My name is Andy Quito, and we're here. So I want to talk about the budget for the third track project. It's been going very well and on budget. There's nothing wrong with the station and all the stations on the main line. Everything has been going well. I mean, yeah, there's a little hiccup, but it's going to get much better. You know, in the Long Island Railroad committee meeting this morning. So yeah, let's talk about budget security for the MTA. The state of New York needs to pass $1.2 billion to hire more private security, especially around Mineola Station and Bayshore. I mean, Bayshore should get more police right now. Take them out of Mineola and put them in Bayshore. You know, my brother has been told me that he has seen homeless people harassing passengers at the Bayshore LA Divorce Station, along with Woodside, Jamaica, Hollis Station. So yeah, we need more police there. The only thing was on the LIRR needs is 1 or 2 police station at the train station and at the parking lot, because we got trying to take pictures, and they've been told twice to get off the parking lot, because the parking lot is for commuters only. You know. Hold on. Sorry, so yeah, that's what, I'm sorry for the interruption, but you know, yeah, but that's what we need, you know, for extra security at the parking lot. You know, people trying to go out there and say that they were taking pictures of you know, what they're not supposed to do. You know, it's getting out of control. It's just complete lawlessness, man. And then fix up the trains, you know, on the LIRR. You know, I got delayed last week because of equipment trouble, because it was Fashion Week, and I got delayed because the train was running late because of equipment trouble. Fix your trains. Put more money into these trains. You know, it's gonna get out of control. I know Passengers United, Charleston doesn't care. You know, about me, about people going to like things like Fashion Week. And,
excuse me, please wrap up your remarks.
yeah, we'll conclude my remarks. And finally, I am glad that the J&Z subway line has resumed at Jamaica Center. So thank you so much for watching. And I hope you put more money into security to keep people safe at Mineola, Jamaica, Bayshore, and Hollis. Thank you so much for watching, and have a great
Mr. Chair, this concludes the public comments.
All right, thank you, Mark. All right, well, welcome all board members, and Harry, we know you're keeping everything warm up in Orange County, so thanks for joining remotely. Hopefully everyone had a nice summer. We have a relatively light agenda today relative to our previous meetings in the spring and early summer. A brief thank you to Kevin and your team. I think we had some intense and meaningful discussions before our break on what the, not just this year, but what the next few years looks like, and I think it's important that we keep note of what's happening. We have a little bit of positive news you're going to talk about, as you heard earlier, on ridership, so that obviously translates down into the budget, but it's very early and very cautious and in line with what we've suggested the next few years may look like. So we'll talk about that, but keeping your mind's eye on the future is very important, because the near term may be clean and straightforward, but the next few years are not. So that's where we are. Very perfunctory order of business. Give a motion to approve the July minutes, please.
So moved.
Second? Yeah, please. No, that's
Sure.
fine. We have a motion and we second. Then we can take edits,
sure.
and then we can go when that's over.
Page 8, the middle paragraph, to best fund.
Hold on.
Yeah.
Whoever's looking, who's following it? Okay, keep going.
Page 8, the middle paragraph, to best fund and deliver transit services, not delivery. And on page 9, the bottom paragraph, and has been focused on initiatives, not focuses. Those are the two corrections.
Okay, well, Andrew, I will tell you that the New York Times and many other newspapers have been severely curtailing their copy edit desks, but your career path was sorely missed. Copy editing would have been a right up your alley. Okay, all in favor say aye. Opposed, abstentions, motion passes. Thank you. All right, unlike our usual sequence, our CFO himself will take Budget Watch in part because of the slightly changing news. So, Kevin, the floor is yours.
Thank you, and good afternoon. I am going to walk through Budget Watch, really just a summary, and then open up to any questions you have for me or the staff who would have more detail. As Neil mentioned, we have some modestly positive results to report in this month's Budget Watch, so let's go through it. First, as a reminder, this Budget Watch reflects actual results through the end of August, and the year-to-date variances are relative to our updated July financial plan, which had already updated for actual results through the end of April, as well as the new ridership forecast. So through the end of August, our overall financial results are $531 million better than the plan for the current year. This is due to a combination of lower expenses and higher revenue from both fares and dedicated taxes. So all major categories contributed to the better results. First, on the revenue side, fare and toll revenues are $104 million better than planned, spread across all the agencies. And so one thing to think about, that $104 million, that's really 4 months since April. So remember, April, when we built the July financial plan, it was on the actual April results, and then the McKinsey projection that was done in May. So we're not $100 million better in 1 month. It's over the 4-month period. You'll see that the net benefit to operating revenue is only shown at $64 million. That's due to other adjustments really on the non-cash side, particularly the change in the market value of our captive insurers investment portfolio, which is not a budget item, but is reported on a consolidated basis. So what drove the higher revenue numbers? So first of all, as has been reported, ridership is better than expected. It is just slightly higher than our financial projections. If you look at the percentages, we're just within 1% of the ridership forecast that our financial plan is built on. The incremental revenue is based on a more favorable mix of ticket sales, primarily more of our returning customers buying daily tickets rather than the discounted monthly tickets. Again, remember, this is projected through the financial results through the end of August. Looking at the first couple weeks in September, the trajectory is very good, but again, it's within that, the middle of the range of what we've been forecasting. Dedicated taxes are 121 million favorable to the financial plan, mainly due to continued strong real estate-related tax receipts, both in terms of the mortgage recording tax and the real property transfer tax. So even though we had projected cooling off, that we're continuing to see good collections. So that's the favorable revenue side. On the operating expenses, year-to-date operating expenses are 307 million lower than the financial plan, reflecting lower expenses across both payroll and non-payroll expenses. Although a portion of this is timing related, particularly with respect to some of the non-payroll material costs and so forth, these good results show our ability to run robust service at a lower expense level. And we're continuing to find ways to build on this success as we move into finding solutions for the fiscal deficit. One note on the unfavorable side, we continue to struggle with overtime expenses as they've been running about 25 million over budget on a monthly basis, which is primarily due to employee availability and vacancy issues. Debt service is slightly better than planned, in other words, lower expense. This is really due to some of the timing of our planned borrowings, not from lower interest rates, which, as you know, are significantly higher and will impact our debt service down the road as we do borrowings in the later part of the 20 to 24 capital program. So it's clear to me that the combination of our constraint in spending and higher revenue over the last few months are good facts. But importantly, on the expense side, we are hard at work adding longevity to a lower cost structure to provide part of the solution to the fiscal cliff. We got to take those savings on expenses and put them in place for a longer term. Which I must remind everybody, our fiscal cliff, even irrespective of this news, still looms large at $2.5 billion per year. But we do welcome the short-term positive fiscal performance. With that, I will open it up for questions.
Questions, anyone?
So,
Yep. Oh, all right. Andrew,
just
Hayden first, then Andrew. Go ahead.
so just a thought. So was McKinsey wrong that people were not, I don't want to say that, but,
So the McKinsey, remember, currently where we were even in the first 2 weeks of September is within 1% of the ridership forecast. So, McKinsey, 62 versus 63% or something like that. What's driving the 100 million higher results is just that little bit in extra ridership, but much bigger, yield in terms of our ticket mix. So what we asked McKinsey to forecast was ridership, and then we translate that into revenue based on historical and expected ticket mix. And the ticket mix itself has been worth almost the equivalent of 2% increase in ridership.
Andrew?
Does your forecast and estimates take into account the fare evasion that is taking place now throughout the system?
It does. So just to remind everybody, so obviously the current results are, the impact of fare evasion. And if you remember, our July financial plan is built on paid ridership increasing, at a relatively gradual pace from the 60% to the 80% in 2026. One of the ingredients of that is better performance on fare evasion, As you know, the biggest things we need are the office work, returning to office, really the crime and safety issue and people's perception of the system, and then getting, people to do more non-work trips, return to retail and entertainment, so forth and so on. But it is built in, again, hard to forecast fare evasion, but we need to get better just to meet our financial plan projections.
Thank you.
Please, Jerry, please.
Yeah, I know we have a lot of locked-in contracts and whatever, but how is inflation affecting the MTA's financial picture?
Right. So the you are right that the way we budget our projections, we have a lot of locked-in contracts, so those are paying out. On the material side, I will say, first of all, like on fuel, we're seeing that impact immediately. We do have, we do hedge 50% of our near-term fuel costs, so that's been an offset, but we see that kind of feeds through. On the material side, we've yet to see on an aggregate basis our material spend going above, and part of that is, I'm sure material costs that we haven't contracted are coming in at higher costs. It's that they're coming in at a slower pace because as we work out through the supply chain issues and so forth, if there's less material available to buy, even though maybe you're paying more for it, your overall spend is less. So I would say the areas we're seeing inflation, more immediate is like on the capital side as we're bidding out projects. You can kind of see some of the escalating costs there a little bit more immediate. But it is, as we pointed out, it's a risk to the financial plan that, we're closely monitoring, and obviously the impact on, wage settlements down the road will, be key too.
All right, I'll ask one then. A similar vein. Did you have one? Sorry.
I did have.
Yeah, go ahead, please. Go ahead. No, Sharif, go ahead, please. No, the chair comes last, like the general eating lunch at the
Okay, well,
field.
you're very gracious, Mr. Chair. Just a question on the PBT, the petroleum business tax. In your notes here, you say that the shortfalls are due to lower taxable activity. Can you just explain that a little bit more?
Yeah, so the petroleum business tax, unfortunately, is a volume-based tax rather than a price-based tax. So even though if it was a pure sales tax on petroleum sales, we probably would see an increase in that, like, people have been seeing an increase in sales tax. So I think it's a reduced volume. We are held harmless on the gas tax holiday, although that doesn't apply to the petroleum business tax. That's on the motor fuel tax. Did that answer your question?
So then two points. One, a question, one, a request. The question, which is I think in the similar vein to Jerry and Sharif's question, which is, okay, real estate. You mentioned that we're seeing receipts pretty good. We obviously are seeing rates almost 6% now with mortgages, that at some point, if it doesn't drive pricing down for real estate, it will certainly cool down the number of transactions. So how are we feeling about when this is going to hit, the real estate slowdown is going to hit us, and to what magnitude? I don't mean numerically, but like, can we go back to an earlier time of slowing down of real estate to understand, because it is a meaningful part of our revenue source, which we obviously have no control over.
Well, you're right. It is our most volatile stream, and the two areas are the mortgage recording tax, which is collected throughout the MTA district, which is based on the quantity of mortgages. So higher home prices help, but the loss of refinancings, which also trigger a lot of the mortgage recording tax, is probably the most worrisome part of it. And then the real property transfer tax, mainly that we collect within the city, is sales of large commercial properties. you know, if you look back at history, the biggest impact to MTA's budget, you know, coming out of the global financial crisis was the, I think, almost $1 billion decline in our real estate-based taxes. So it's nothing to sneeze at in terms of risk. I mean, that was the global financial crisis, all financial markets seized up, so all activity really ground to a halt. Here it's, you know, there's still good activity, but as, you know, obviously a lot of concern. So something we're watching. We do look at how the city forecasts their real estate taxes and try to compare, and we've tried to be, you know, for example, when we built the July plan, even though the taxes were showing great increases, we didn't keep assuming they would grow. We flattened them out. And if you look at the city projections, they project a slight decline and then kind of a return. The state controller has less of a decline. So we look at it all, but it's really you know, I'm sure Robert knows it's a hard, probably one of the harder taxes to forecast.
So then my request is, I think given the number of new board members, it will be useful. You have these as footnotes in Budget Watch, but I think putting together a single page of the drivers of each of our revenue sources. So for example, the MRT is X percent and it's multiplied by these geographies, and the urban tax is the commercial. You have, again, they're in many of the footnotes, but I think for board members' ease, it'd be nice to have one sheet of paper that just lists, I'm sure you have it somewhere. In fact, you probably have it. Jai has it probably as a poster in her office. So if you would just miniaturize that and send it around, I think everyone would benefit, because Sharif's question is one that, you know, a footnote in font 8 is not the most accessible item. So if you wouldn't mind.
We definitely have that, and we will put it together. There are schedules in the financial plans themselves, might be more detailed or less descriptive than everybody wants, but we'll put together something that's a nice
Executive level, right. I think is.
And I'm sure the following question will be, okay, well, so how's the burden split between the city and everybody?
I don't think
else
anyone said
relative to
anything
level
about
of
city
service?
versus state. Don't make it any harder on yourself.
But, well, no, it's important to look at how the burden sharing of the taxes are.
Sharif?
One more obscure footnote.
Okay.
No.
Is this a test?
No, not a test.
You're doing great. You're doing great.
What piqued my interest, out of curiosity, the FHV surcharge. Your forecast,
Yes.
You're actually right on target in terms of forecast and actual through September. What's the forecast for the entire year? Because, you know, you hit your 300 million, anything above
Right.
that goes into a different
Yeah, so the
account,
first
if you
300
will,
million
outer
goes to
borough
MTA,
account,
the
yeah.
next
Yeah.
50 million goes to outer borough, and then
Right.
everything else goes to general transportation. So I'll have to get back to you with the exact numbers for this year, but I believe it's some money to outer borough above 300, but don't hold me to that. And then in future years, we see it forecast to start climbing above 350, so both to provide money to the outer borough account, and then a little bit above the 300. But let me get you the full details on it.
All right, thank you. Pat, Finance Watch, please, sir.
Yes, sir, Mr. Chairman. Finance Watch is on page 23 of our director's desk. We did something a little different this month. We created a one-page executive summary that hopefully it's intended to distill the most important information on our capital markets activities. But I'd love to, if you have other comments or refinements you'd like to make, please let us know. Since July, we have issued $965 million in 2 series of bonds to fund approved capital projects. This is what we call new money bonds. The first was August 8th. We issued $400 million of TBTA general revenue bonds with a 10-year yield to the first call date of 3.824%. Following that, on September 15th, we issued $497 million of TBTA payroll mobility tax senior lien green bonds. Here, the 10-year yield to the first call date is 4.367%. The difference in those call dates speaks not only to different market conditions on the days that those transactions were priced, but also the structure of the bonds, whether we structure level over 30 years or whether we issue the bonds more on the kind of the longer end of the yield curve, 25, 30, 35 years. So that's why you'll see those differences in yields. We also were busy in the refunding arena. We issued 2 refunding transactions with the TBTA payroll mobility tax resolution. We refunded $273 million of transportation revenue bonds that generated $21 million in present value savings. And then we refinanced $951 million of bond anticipation notes. We just extended those notes out for an additional 2 years at a yield of 2.35%, and that compares favorably to a longer term issuance at the time, which would have been about 4.5%. That transaction was posted for competitive bidding. The winning bids were submitted by Bank of America Merrill Lynch at $426 million, JP Morgan at $300 million, Wells Fargo at $175 million, and Goldman Sachs took $50 million of that. We extended a letter of credit from Bank of America. We negotiated renewals for standby operating lines of credit with Bank of America and JP Morgan for $400 million and $800 million respectively. These are standby lines of credit. We have not drawn them. They're just available for future use should we need them. And then lastly, we have the monthly fuel hedge. Each month we lay on a fuel hedge intended to really handle the cost of about half of our supply over the next 12-month period. And there's more details on our fuel hedging program in Finance Watch, in the Finance Committee book. For July and August, we purchased approximately 2.8 million gallons each month at an average price of $2.92 a gallon, sorry. So that's the kind of the high-level Finance Watch. I would just note that if you turn to the second page, we included a chart in there, which a picture can, is worth 1,000 words. And the picture that we're showing you here is just the rate environment over the past year. What you can see from the Revenue Bond Index is that just a year ago, our cost of long-term funds was about 2.5%. And just last week, that index went over 4%, as a broad measure of the cost of funds, I should say. And
I don't know if the team is that. If that's not possible, it's okay. Oh, David, go ahead. Well, let Pat finish. Let's just about how to show it. Can we get it up any chance?
I don't know if
they left us.
They might.
That's okay.
It's on page in your iPad. It's on page 24.
Here, I'll make it really big.
Sorry,
it goes
I should have had that ready to put up.
All right, I'm not laughing. It's going to be funny. Yeah, that's right. Stay like that. Don't move. Don't move, chair. Keep going. Sorry.
Okay. So anyway, the chart's on page 24, and again, it's intended to just give you a feel for what is the cost of money currently, and those 3 transactions that I reported on here are shown with the gold dots there and those yields. So anyway, happy to take any additional questions if there are.
David, of course, please.
Yeah, I've been concerned about this. What percent of our expense budget is now going to have to go to supporting, obviously, interest on these bonds?
Sure. So what you're talking about is the debt affordability,
debt affordability
analysis.
Yeah.
So I don't have a current update of that. I can tell you that in the July financial plan, we were. Do you recall where we're at for the current year? We're at 17% in the current year.
So still basically within the parameters we'd heard about before.
Absolutely.
You think that's going to stay that way, or if we continue in this environment?
It's absolutely our intent to keep that ratio
right
in that sort of 15 to 20% range, which is what we have seen historically.
Yeah.
I know.
Yeah, I'll comment on that. We will be able to keep it in the range, and we're continuing to find ways to actually still generate savings in our annual debt service versus what's in the budget. And so as Pat mentioned, for example, when he mentioned we rolled a $900 million note for 2 more years at a 2.5% interest rate, okay, versus we could have sold it out for 30 years at 4.5%. Now you're like, well, will that pay off, or will rates be 6% when you refinance it? But the point is that if you think back about our debt portfolio, about 95% of it is fixed rate, and the board long-term fixed rate, and the board policy is to have up to 25% of that be shorter term or floating rate. And so we've got lots of, first of all, just by every time the Fed raises rates, our interest cost doesn't go up materially. And then as we manage the long-term market, we have the capacity to do things like do a 2-year note and save a couple hundred basis points in interest costs. So I think the bigger issue on interest rates is not necessarily the near-term financial plan, but long-term, when you issue more and more bonds for the 20 to 24 capital program, that we're going to be in this period where we won't have much debt issuance.
Obviously the city is capped. It's at 15%. Whether at some point this board might want to make a hard cap of some sort, and not to drive you crazy, but just to safeguard future generations using the system.
Right.
So.
Yeah,
That's a big topic. You've been a very consistent and thoughtful advocate for that discussion. I think that's a worthy topic for another day, because unfortunately, there's not much we could do about that right this second, especially with a 50-some-odd billion capital plan that we're about to execute.
Right, but David, I will comment that part of the presentation in July was showing alternative ways to lower the cost structure, part of that on the debt side. So I do plan on coming back to the board in November with some ideas of what we can do with our fixed expenses like debt service.
And of course, we're projecting that we have to have fare increases coming forward. And the question of how, if that does not happen, what the implications are for us.
Thankfully, we have a talented CFO and a very active board, so we'll be having those conversations, I think, around the November timeframe. Thank you. Any more on that topic, Pat? Okay, action item, Pat, back to you.
Sure. We have one staff summary in the book for your approval. This is to obtain approval of a competitively negotiated personal services contract with Stantec Consulting Services, Inc., to provide consulting services as an independent engineer required by the MTA TBTA general bond resolution for a 5-year term. This would include 1-year option for renewal at a not to exceed cost of $1.106 million. I'd be happy to take any questions.
Get a motion for that? Second? Any discussion? None? All in favor say aye. Aye. Opposed? Abstentions. Thank you very much. Okay, we've got 2 information items in the book here. The first is a preliminary budget and financial plan that was presented in July, just so you can look at that. The second item pertains to a contract approved by the CPC committee earlier today, meaning before this meeting, related to the performance of interim maintenance of various Grand Central Madison facilities. C&D staff are available to answer any questions. Are there any questions? Okay, Kavesh.
Thank you, Chairman. Good afternoon. There's one item for Finance Committee approval this month in the not-to-exceed amount of $4,762,800. This item is found in the September Finance Committee book on pages 47 to 49. This is an award of a 5-year services contract to Hill International to provide independent engineering services for the certification of transit and railroad programs. And Hill will function as the independent engineer with the responsibility of certifying that the inspection, maintenance, and repair programs adopted by the MTA's agencies are appropriate and sufficient, and also to ensure the continued operation of the system as a whole. I submit this for your approval.
Mr. Chair, I'll have to recuse myself from that vote.
Well, while as unfortunate that sounds, duly noted. All right. Okay. Okay. Can I have a motion to approve, please? Second, David. All right. Any discussion? Please, go ahead.
Can you just explain it a little bit more so I have a better understanding?
Yeah, Kavesh, I think in particular that you're talking about an IEE, an independent engineer, related to bond covenants. Maybe you should just go a little more detail about what they're actually reviewing.
Yeah, so basically, what Hill International will do is we have various programs across the MTA and all the agencies, and what they would do is analyze the programs in terms of cost estimation, the provisions that are allowed under these programs, and be able to certify that and come up with whether it's sound, it's rational, and whether those provisions and financial assessments actually will make sure that the system as a whole runs.
Yeah, just to give you context, so this is a requirement since the bond investors on our transportation revenue bonds, part of their security is the fare box revenue. They want to, there's a contractual requirement that we get an independent entity to confirm that, the way we're managing the system from a maintenance perspective, it's consistent with being able to generate revenue over the long term. So it's a contractual obligation under our bond covenants.
So we are required to have it. And then the second thing is Hill is the current provider of said service, yes?
That is correct.
Okay, thank you.
And we actually got them in a best and final offer to lower their price considerably.
Yes, correct. In fact, on a positive note, we did some very intensive negotiations with them and got them to decrease their price by $1 million.
Okay, we have a motion and seconded. All in favor, say aye. Aye. Opposed? Abstentions? Okay, motion passes. Thank you very much. Kavesh, continue, please.
Thank you. Chair, there are two more information items, one for Metro North and one for New York City Transit in the Finance Committee book, both of which have been approved by their respective committees today.
Okay, not requiring any vote from us?
No.
Okay, great.
Thank you.
All right, thank you very much. Consolidated financial and operational reports are on pages 52 to 154. Any questions on those? From all your weekend reading? No? No? All right. If not, David, over to you, please, on real estate.
Thank you, Mr. Chairman. Real estate has 7 action items for consideration and approval. There are 2 items for the Metropolitan Transportation Authority. The first is for the acquisition of property interest for Phase 2 of the Second Avenue Subway project. The second is an amendment to the Grand Central Terminal short-term license program that includes the Grand Central Madison Retail Concourse. There are 2 items for MTA Metro North Railroad. One is the report on the determination and findings associated with eminent domain proceedings for the acquisition of property interest for Penn Station access. And the second Metro North item is the acquisition of property at 4 Fisher Lane in White Plains. The next 3 are for MTA New York City Transit. The 5th item is a surrender of surplus zoning floor area and certain easement interests to the City of New York at the Garfield Place substation in Brooklyn. The 6th item is a lease extension with Thor Equities for the existing office space at 180 Livingston Plaza in Brooklyn. The 7th and final item is a license agreement with South Hill Food Incorporated for 2 retail spaces at the Atlantic Avenue Barclays Center subway station in Brooklyn. Bob Haley, the head of MTA Transit R&D Development, is here to answer any questions regarding the Second Avenue subway and Garfield Place zoning rights surrender. There are, in addition, 3 information items. Happy to answer any questions regarding any of the foregoing.
Please, Sharif.
Just a question on Second Avenue subway. So in the staff summary, it talks about if there's a negotiated agreement, you come back to the board for approval of that agreement. If you undertake eminent domain proceedings, is there any circle back to the board on those actions?
When you follow the eminent domain and actually acquire title through a court proceeding, the valuation is determined in the court. So it's based on appraised values, and it's just a court-ordered valuation.
Sounds like the answer is no, I think, to your question.
The answer is
Yes, the answer is no. So in other words, it's handled in the courts.
That's correct.
There is no discussion or action at the board about the actual compensation level for that particular property.
That's correct.
Thank you.
Other questions? Okay, these are some heady real estate items related to major capital projects, so I think we should be mindful of that when we have this vote. So can I have a motion then to approve? I think we're taking them as a blanket, yeah.
I make a motion.
Okay, second? Can we get it second? Okay, thank you, sir. Okay. Any discussion? Okay. All right. We have a moved motion and a seconded, so all in favor say aye. Aye. Opposed, and one abstention. Okay. Okay, I think that concludes our business. Can I have a motion to adjourn? Oh, sorry. No? Good. Any new business? No? Motion to adjourn? Second? Okay, thank you all very much. Thank you, staff. Have a good night.